Hi guys, I hope you're well. Nick here, MD at Verta Property Group. So today we are running through the pros and cons of off-plan property investing. Obviously, it's our core focus at Verta Property Group, but there are some considerations. It's not right for everyone. However, for the right investor, it can be very powerful and deliver some phenomenal returns. So today I'm going to run through the advantages and disadvantages just so you've got a good idea. Right, so what is off-plan investing? Ultimately, it's where you buy a property during the construction period for a discounted price typically, and you're basically paying less and getting more advantages because you're buying earlier in the construction period, sometimes before construction's even started. And obviously, the idea is you're going to benefit from the value increase of the property throughout the build and from the natural market momentum. So, yeah, you're buying early at a discounted price, you're putting your deposit down, you're benefiting from the growth during that construction period. And then obviously, you become the owner of that property on exchange, and then you're able to rent it out on completion. So, yeah, put simply, it's buying a property during the construction period. Now, deposit levels on these types of investments are typically 10 to 30%, depending on the developer's payment structure. The build period can be from anything. I mean, typically it's 12 to 24, but it can be a lot sooner. 6 months from completion is still technically off plan. Obviously, you have your 10 new build warranty, but ultimately you are taking somewhat of a risk. Excuse me, and the returns aren't completely guaranteed. So we're going to look at the case for and the case against. Now let's do one by one. So first pick of the building. So as a development is released to market, obviously it typically goes out to investors. Companies like mine will contact their property buyers, previous investors, new investors, etc. And they'll say, look, we've got this new development that's launched. Do you want to have a look at it? And obviously the people that get in early, they're able to choose the best units in the building. So it might be high floor units, might be corner units, it might be larger layout units, it might be just generally unique layout units, it might be units with a better view, etc., etc. But by picking the best and most unique units in any one scheme, obviously it's a bit of a differentiating factor and it allows you to lead the rent in that particular building. In other words, charge the most money. So yeah, picking a unique unit and having a differentiator is a really strong advantage in my opinion. Touched on this already, but today's price on tomorrow's asset. So what you're doing is you're buying the property now, and even though it completes in 2 years' time, obviously you're not paying the price for 2 years. So you're paying today's rate, and you're only putting down a deposit for that. So yeah, you're getting a discount, you're buying at today's price, so you can benefit from the value rise of the construction itself, i.e. a project that is 3 months complete from completion versus one that's 24 months completion obviously has very different valuation, and the one that's closer to completion will be worth more. So if you buy earlier, you're going to benefit from that uprise during the construction period. But don't forget, you'll also benefit from the natural market momentum. So if average values of that local market are increasing a lot or increasing aggressively, then you're going to benefit from that as well. So you put those two factors together, the uplift that you can make during that build period is quite significant, especially in markets like Liverpool, at Manchester, where it's growing at 4, 5, 6% per annum in a natural marketplace. Cool. New stock commands higher rent. So you get a new flashy building in the center of town with great communal facilities, large units, new furniture, obviously all nice and shiny, then that's going to rent more than a resale unit or a rundown unit that's been on the market or been built for 15, 20 years. And that goes the same for houses as well, right? So we get a lot of investors that compare new build city centre apartments to freehold terrace houses. So yeah, obviously, where do tenants and where do good tenants want to rent? Where do young professionals want to rent? Where do executives want to rent? Ultimately, it's in the city centre in these new shiny buildings. It's not really on a terrace house for 70 grand on the outside of town. So keep that in mind as well. Structural 10-year new build warranty. So from the likes of NHBC, Advantage is another provider. But yeah, that allows you to get covered for the structural repairs, etc., etc. Incentives, this is a big one. Ultimately, you've got to look at the commercials of when you're buying into a development in terms of the sales process, e.g. normally developers, when they just launch a project, they normally have a lot of interest straight away because it's fresh to the market. Then it does die down a bit, and then as you get closer to completion, it tends to slowly scale up until you get into the high demand properties just prior to completion. But the earlier you buy, generally Or if the developer's going for a slump, that might be sometimes in summer months it cools down a bit. January can be quite slow, obviously over the Christmas period as well. Developers are obviously keen to shift their units, especially if they've got a lot of pipeline coming to market. So you are able as an investor, and it's our job to negotiate this for you, is to get improved incentives, and that might be a free furniture pack, stamp duty contribution, discounted management rate, legal fee contribution, etc., etc. So you can squeeze these extra incentives out of the developer, as well as buying in at that lower discounted price as well. Generally remote or genuinely remote as well. So obviously, if you're buying a property that's ready now, generally you're going to have to go and view it, have a look, assess the street, assess market comparables, etc., etc. But when you're buying off plan, you're buying from a brochure, you're buying from videos. You can look at the developer's track record online. You can look at Google Maps. You can have Google Meets with the developers or our team or our competitors' teams. Hopefully not. And get an understanding of the scheme, and ultimately it is a desktop decision. And finally, the deposit works on the full value. So this is probably the most important thing. You have to remember when you're buying off plan, you're putting down, let's say, a 20% deposit. You're benefiting from the growth of the full value though. So you're putting in 40 grand on a 200 grand profit. If the market increases by 10% over, let's just say, a year, then that means that that property is now worth £220,000, but you've only put in the 20% yourself, so the 40 grand. So you've made £20,000 profit on a 40 grand investment, which is a 50% return on cash invested figure in a year. So that goes to show you how powerful it can be. Now, I'm not saying every property on the market is going to increase by 10%, or every off-plan property is going to increase by 10% per year, but a 15 to 20% value rise during a 2-year build time frame in a strong location is not uncommon. So some of our options, you can get 50, 75% return on your deposit during that construction period, which means you're getting a return in cash invested figure of 37.5% annualized, in other words, per year. So it's a misconception that people think they're not making any money when they're purchasing off plan, and you have to think about that return on cash invested figure, because if you buy a ready property, it's not going to increase in value as aggressively, although you have the rental income coming in. So there's pros and cons. You need to assess it on a case by case basis. There's different payment structures, different obviously deposit levels, incentives available. So all this stuff you've got to add up and then make an informed decision. So as long as your broker is giving you all the relevant information, then you can make that or weigh up the pros and cons effectively. But yeah, don't write off plan off, because as I say, Liverpool at certain times is growing 6-7% a year. If you look at Office for National Statistics data, Home Track at the moment has reported current annual growth of 4.5% a year. So if you add that to the value that you're making during the construction period as well, it can be extremely profitable. Okay, let's move on to the what I call considerations, or the case against, or the disadvantages. So you definitely have to think about. Now, some of these are going to be more apparent on certain investment opportunities than others. So you need to assess the options you have in front of you. So firstly, you pay a new build premium. It's a bit of a myth that every new build property is overpriced, but you have to consider that you're buying a new property, you're not buying an old property. Same way when you buy a new car, you're paying a premium for it in comparison to buying something that's 20 years old. So you are paying a premium to get a new property. No income until it completes. As I mentioned, you can make equity, or you can build a profit during that construction period, but you're not going to have that monthly cash flow like you would if the property was complete. Your deposit is committed and exposed. There are certain deposit protection schemes in place, typically up to 10%. It used to be a lot more common. Some developers simply don't have that at all now. So there is an element of risk that you have to consider of your deposit. It's not the case that necessarily that goes straight over to the developer. It doesn't go, if your deposit is 20%, it doesn't mean that you pay 20% to the solicitor, then it goes straight to the developer and in their back pocket. Typically what will happen is it goes over to this lister. Quantity surveyors visit the site during the construction period. They tick it off and verify the work that's done, and then developers are able to draw down on those funds throughout the construction period, so they're not getting all the capital up front. However, there is an element of risk, and you have to consider that you are ultimately handing over 10, 20, 30% to the developer, even though it's drip fed to them. Cool. Growth in the build is assumed, not banked. In other words, it's not a guarantee. No one knows 100% what's going to happen in the property market. Yes, we can look at past performance. We can look at expert projections. We can judge the sentiment of the marketplace ourselves. We can look at the supply in the local area. There's lots of stuff that you can do, but ultimately, at the end of the day, it's not guaranteed. The same as the stock market's not guaranteed, or the crypto market's not guaranteed. So keep that in mind. Finance can't be locked at exchange. In other words, you can only sort out your mortgage about 3 months from completion when you're investing in off plan. So if you buy something that's 24 years away, 24 months away, you can get an agreement in principle from a mortgage broker. You can have a chat with them and get a basic understanding of your lending ability, but ultimately it will be finalised on completion, as will the valuation. So keep that in mind as well. It's a leasehold purchase, not as much of an issue these days. Nearly everything we bring to market is a 999-year lease. Ground rent, you don't have to pay anymore. Things like service charge, you definitely have to make sure that's reasonable. Look at the block budget, look at who's managing the site, etc., etc. There are some considerations that you need to tick off and ensure you're doing your due diligence properly, but the lease issue in itself isn't too much of a problem these days, given regulations, etc. And legals and track record, kind of the same point. Basically, you need to verify you're dealing with a decent developer that's not going to take ages to deliver, that's not going to have poor customer service, that's going to liaise with the legal teams, do your snagging correctly, etc., etc. So you do need to make sure you're working with a credible developer, and that's going to deliver you a good product and make sure you get what you're paying for, basically. So yeah, that's it, guys. I'll wrap it up there. These videos are designed to be on the shorter side, so that gives you a bit of a breakdown of the advantages and disadvantages. Check the link in description if you want more information, or you want myself or anyone from my team to assist in assessing either complete, new build, off plan, HMOs, property investment bonds, student accommodation, etc., etc. We'll be happy to help. Thanks for your time.